The most expensive financial mistakes in history never feel like mistakes. When they are happening, they feel like nothing. A slightly higher grocery bill, a vacation that costs a bit more than last year, the quiet, creeping sense that your money does not stretch the way it used to. No crash, no headline, no single morning when you wake up and know something has gone wrong. Just the slow, invisible arithmetic of a currency repricing against the things you actually buy. And by the time most people feel it, the damage has already been compounding for years. Stanley Druckenmiller spent 40 years profiting from exactly these kinds of invisible shifts. On January 30th of 2026, in one of his rarest public appearances in recent memory, he sat down at Morgan Stanley and said something that almost no major financial publication actually led with. He said he is bearish on the US dollar, not cautious, not hedging against a possible weakness, bearish, actively positioned against it. And the reason he gave was specific. He said foreigners are, in his exact words, way overloaded in dollars. MarketWatch covered the interview. Yahoo Finance covered it. Bloomberg ran a summary. One of them made the dollar call the headline. Every outlet focused on the AI pivot, the biotech position, the copper trade. The sentence that should have stopped every investor reading it got buried in paragraph 7. This video is going to do what that coverage failed to do. It is going to explain exactly what Druckenmiller said, why the reasoning is more grounded than anything else circulating in financial media right now, what history tells us about the last time this precise setup appeared, and what it means practically for anyone trying to protect wealth over the next several years. Stay with this until the end, because the final piece reframes everything that came before it. To understand why the dollar call is so significant, you have to go back 40 years, not for nostalgia, because the setup is almost structurally identical to what preceded the largest peacetime dollar decline in modern history. And the last time it played out, the people who were not paying attention lost nearly half their purchasing power over 2 years. Without a single market crash, without a recession, without a headline that said the crisis has begun. The year is 1985. For the previous 5 years, the US dollar had been appreciating against every major currency in the world. By early 85, it had climbed roughly 47%. American assets were the most attractive destination for global capital. Foreign investors, foreign governments, foreign pension funds poured money into the United States. The trade deficit was widening, and most people did not feel any of this as a problem because a strong dollar felt like strength. Things from abroad were cheap. Imports were affordable. European travel was a bargain. Here is the detail that never gets mentioned when people tell the Plaza Accord story. In the weeks before the agreement was signed, White House staff traveling to West Germany for diplomatic work were spending their afternoons shopping for BMWs. Because in 1985, with the dollar at peak strength, a German luxury car cost roughly half what it would in the United States. They were not being reckless. They were doing exactly what a rational person does when their currency is historically overvalued. They were buying. 6 weeks later, the finance ministers of 5 nations met at the Plaza Hotel in New York. They signed a document. The following Monday, the dollar fell 4% in a single day. Over the next 2 years, it fell 40%. Not in a crisis, not in a crash. Gradually, persistently, almost silently, the people buying BMWs at half price watched that arbitrage evaporate. The people whose savings were entirely in dollar-denominated assets watched their real purchasing power erode by nearly half, with no red number on any screen, with no panic, with no single morning they could point to and say, that is when it happened. Now comes the bridge that most coverage misses entirely. Druckenmiller was 22 years into his career when that accord was signed. He absorbed a lesson that most investors intellectually understand but never truly internalize. Currency shifts do not have the shape of emergencies. They have the shape of a slow tightening of a belt, every month slightly tighter, and then one day you realize you cannot breathe. In 2026, he is saying the structural conditions have reconverged. The dollar is again near the top of its historic purchasing power range. The trade deficit is again substantial, and foreign investors are again overloaded in dollar-denominated assets. His words were precise. Way, way overloaded, not slightly, not moderately. Way, way. That repetition is unusual for someone who is typically measured and exact. It signals conviction. The key difference from 1985 is that this time no Plaza Hotel meeting is required. He said it directly on camera. If foreign investors simply stop buying American assets on a net basis because of the trade balance and because of the position, the dollar will go down on its own. No coordinated intervention, no policy shock, just gravity pulling an overextended weight back toward equilibrium. This is the crisis nobody is talking about, not because it is hidden, because it is slow, because it does not generate the kind of instant visible damage that produces financial headlines, and because the people who would normally explain this are busy covering the next earnings report or the next Federal Reserve meeting, and a currency repricing that takes 2 years to play out does not fit the news cycle. So, if he is moving away from the dollar, where is he going? Most people assume they know the answer. Gold, maybe. Defensive stocks. The standard playbook for dollar weakness. His actual largest new position is copper, and the way he described it in the Morgan Stanley interview reveals everything about how he operates. He said it is not a genius trade. It is a big consensus trade. He is not presenting copper as some obscure insight only he has found. He is saying the logic is so structurally clear that following it honestly to its conclusion is almost unavoidable. There is no meaningful new copper supply coming to market for approximately the next 8 years. Mine development from discovery to full production simply takes that long. You cannot rush it with a government policy. You cannot create it with a central bank decision. You cannot print copper. The supply side is fixed, and at the same time demand is accelerating, as what most people understand as a software revolution is at its physical foundation, a materials revolution. Every data center being built for artificial intelligence runs on copper wiring and cooling infrastructure. Every electric vehicle on the road requires roughly 3 to 4 times more copper than a combustion engine. Copper is up 32% over the past 52 weeks. Druckenmiller's view is that the trade is not over, because the constraint is structural, not cyclical. He also holds gold, for a reason worth understanding precisely because it differs from the typical gold thesis. In his portfolio, gold is a geopolitical hedge, not a monetary one. He was explicit about that distinction in the interview. The world is fragmenting in ways not seen since before the era of post-Cold War globalization. Trade relationships that seemed permanent are being renegotiated. International institutions that provided a kind of invisible stability to global commerce for decades are under genuine stress. In that environment, gold is not about what the Federal Reserve will do next quarter. It is about what happens to the value of promises when the institutions making those promises are themselves under pressure. Gold has no counterparty. That independence is precisely what makes it valuable in this specific moment. And then there is Japan and Korea. These two positions received almost no coverage, but they reveal the underlying logic of the entire portfolio. Druckenmiller has meaningful equity exposure in both markets. The Japanese ETF he holds is up 26% over the past year. The Korean ETF is up 97%. The S&P 500, in comparison, is up 18%. But the more important structural point is that both positions give him equity growth exposure through non-dollar currencies. He is not choosing between protecting against dollar weakness and participating in global economic growth. He is doing both at the same time through geography. The currency bet and the equity bet are decoupled now. Here is the part that surprised even experienced market observers. Nearly 30% of the Duquesne family office is currently in biotech. From a man whose legend is built on macro trades and currency bets, that number is startling. To understand how it happened, you need to understand the method he uses to find value, because the method is more instructive than any single position. By mid-2024, his portfolio was, in his own words, very much AI-driven. He had been early to NVIDIA, understood the infrastructure build-out, And then he said it started looking disturbingly concentrated. The comparisons to 1999 were becoming too familiar for someone who had been badly burned being early to short that bubble. So his team started asking a different question. Not what is the next AI trade, but what had the market completely ignored while it was staring at NVIDIA's quarterly earnings. Biotech had been, in his exact words, on its butt for like 4 years. Flat performance, declining analyst coverage, institutional money that had moved on. And yet the underlying science was advancing faster than at any point in the history of the field. He said directly that the best use case out there for artificial intelligence is biotech, through drug discovery, diagnostics, and monitoring everything. The same AI tools that had made technology stocks expensive were being quietly applied to drug development in ways the market had not yet priced. He has spent 30 years on the board of Memorial Sloan Kettering Cancer Center. He is not a scientist. He cannot explain the mechanics of protein folding research, but he knew what it looked like when a field crossed from theoretical possibility to clinical reality, and he saw it crossing while the investing public looked elsewhere. If you have found this breakdown useful so far, subscribe. The next video covers his fourth quarter 13F filing in detail, and the positions in that filing are the next chapter of this story. The specific example he gave to illustrate the biotech approach is worth understanding in full. Teva Pharmaceutical, an Israeli generics company that, to most investors, represented one of the least exciting categories in the market. When his team brought it to him, it was trading at roughly 6 times earnings, cheap for any business, almost absurdly cheap for a healthcare company with a transitioning pipeline. The reason for the cheapness was a narrative problem, not a business problem. Value investors saw a low-margin generics operation with no compelling growth story. Growth investors had not yet registered that Teva was actively transitioning into biosimilars and innovative medicines with significantly better economics. The stock was sitting in the gap between two investor audiences, too unexciting for one, not yet visible to the other. His team looked past the narrative at the actual trajectory of the business. They bought in the mid-$16 range. The stock doubled. Not because of a macro event, not because of a Federal Reserve decision, because the gap between what the company was worth and what the market was willing to pay for it closed, as it eventually always does when the underlying reality is legible to anyone willing to read it. He sold NVIDIA too early. He said it publicly, directly, without any attempt to rationalize it as a near miss or a partial win. He bought in early 2022, well-timed. He cut his position in mid-2024 before the largest leg of the rally. He left significant money on the table. Most investors would file that under wins, move on, and quietly forget the details. He studied it. He asked specifically what signal caused him to exit when he did, whether that signal was correct or whether he had applied it too rigidly, and how the answer should change his process for the next decision. That kind of intellectual honesty, treating a profitable trade that could have been more profitable as a genuine learning event rather than a success to be celebrated, is not comfortable. It requires a relationship with being wrong that most successful people never fully develop. And it is, more than any individual insight or position, probably the deepest structural reason that 40 years without a losing year is possible at all. This leads to something he said that directly contradicts one of the most popular ideas in retail investing. He said contrarianism is overrated. He quoted Soros directly. The crowd, he said, is right 80% of the time. The mythology of the great investor is built on the premise that the key to success is going against the herd, the brave contrarian who sees what no one else sees. Druckenmiller's experience across 4 decades says that mythology is mostly wrong. Most people who try to be contrarian just lose money. The crowd is right most of the time. The skill is not in disagreeing with consensus. It is incorrectly identifying the 20% of cases where the consensus has made a structural error that the data exposes, and then having the conviction to act at scale. The copper trade is not contrarian. The consensus on copper supply constraints is correct. He agrees with it. He just owns it. The biotech pivot was early relative to the crowd, but the logic was not contrarian. The science was advancing. The valuations were compressed. The crowd had simply not looked in that direction yet. The goal is not to disagree with everyone. The goal is to follow evidence honestly, even when it leads somewhere the crowd has not arrived at yet. And that requires something harder than contrarianism. It requires being right, specifically and demonstrably, about where the current consensus has produced a mispricing. Take a moment right now and think about your own portfolio. How much of it is explicitly protected against a sustained weakening of the dollar? Not in theory, not in general, but specifically. Hard assets, non-dollar equities, commodities. Most investors have never been asked to answer that question directly. The honest answer for most people is that their savings, their retirement, and their investments are almost entirely dollar-denominated, with no explicit protection against the purchasing power erosion that a major currency repricing produces. Drop your answer in the comments. The conversation that happens there is consistently more useful than anything in the financial press. There is one final piece of Druckenmiller's portfolio that ties the entire architecture together. He is short bonds, not as a prediction that rates will spike tomorrow. As a hedge, he described his full portfolio as a matrix. He holds copper, gold, biotech equities, Japan and Korea, and a dollar short. Against those positions, he is short U.S. Treasury bonds. The logic is precise. He is long risk assets. If those are right and global growth stays strong and inflation picks up, the Federal Reserve might find itself cutting rates into a booming economy. In that scenario, bonds sell off sharply. The short wins significantly. If something breaks and risk assets decline, the bond short produces a drag, but his defensive positions provide a different form of protection. No single scenario destroys the entire portfolio. That is what a matrix means, not a single directional bet, a structure that generates returns across multiple plausible futures and survives the ones you did not predict. He also said something about the broader macro environment that received almost no coverage at all. He said macro investing has been dead for 10 or 15 years. And then he said he does not think that is the case anymore. What that means in practice is significant. The era of coordinated central bank liquidity of zero interest rates and synchronized policy across major economies created a world where the individual variables that macro investors trade, currencies, commodities, interest rate differentials, were overwhelmed by a single dominant force. Liquidity of that era has ended. Rates are no longer at zero. Central banks are no longer coordinating in the same direction. Trade relationships are fragmenting. The structural conditions that make macro investing viable, diverging economies, real currency misalignments, genuine commodity constraints, are present simultaneously for the first time in over a decade. He called the next 3 to 4 years potentially extremely fertile for investors who understand where the structural shifts are happening. Fertile, not catastrophic, not a crash landing. Fertile. He is not predicting the end of the financial system. He is saying the game has changed. The playbook that worked from 2010 to 2023, buy U.S. technology stocks, hold passively, trust the index, do nothing, is no longer sufficient as the entire strategy. And the investors who are quietly repositioning now before the broader consensus catches up are doing exactly what he has done throughout his career, acting when the evidence compels, without waiting for everyone else to arrive at the same conclusion. His phrase for this, the title of the Morgan Stanley episode itself, is invest, then investigate. Build the position when the evidence is sufficient. Keep refining your understanding as you go. The Teva trade did not require a science degree. The copper position did not require certainty about the exact month when supply constraints peak. The dollar short does not require knowing precisely when foreign investors begin reducing their American asset exposure. All of them required one thing: the willingness to act when the weight of the evidence points clearly in a direction, before the moment becomes obvious to everyone watching. The wealth protection crisis of 2026 has the same shape as the run-up to the Plaza Accord, a currency near the top of its historic range. a trade imbalance that structurally pressures the exchange rate, foreign investors overloaded in dollar-denominated assets, and a slow, invisible repricing that will be perfectly legible in hindsight and almost imperceptible while it is happening. The investors who positioned for the dollar decline between 85 and 87 made one of the most significant trades of that decade. The people shopping for BMWs at half price watched those prices double over 2 years. Without a crisis, without a headline, without a single moment they could identify as the turning point. That is what the beginning of this kind of shift looks like. It looks exactly like right now. Subscribe if you want to be here when we break down the next filing, the next interview, the next piece of the story in detail, and share this with one person who is carrying more dollar exposure than they realize and has not yet asked themselves why. Drop a comment and tell us which part of Druckenmiller's current positioning surprised you most. Was it the dollar short, the copper trade, 30% in biotech, the fact that AI is no longer driving the portfolio of the man who saw AI coming before almost everyone else? The answers in those comments are consistently more interesting than anything in the